Mr. Aniruddha Naha. He's the CIO alternates at PGIM India Asset Management Company. Aniruddha, hi. Good to be speaking with you. Anisha this side. What's the market mood like right now? Because every dip is getting bought into. We all keep questioning the valuations, but I think, is it just the flows which is actually backing the momentum right now? What would you attribute it to?
So Anisha, thank you for having me over. I think your statement says it, your question says it. The flows have been reasonably strong, and that's been driving. Frankly, when we look at earnings, from an earnings perspective, we don't expect until now whatever results have been declared have been reasonably subdued. We expect the subdued earnings to continue probably into the next quarter also. So returns finally is a combination of your earnings and the PE expansion that is happening. I think largely in the market, it's PE expansion which is happening, led by liquidity. We would be a little cautious on these markets.
Aniruddha, we all keep saying that, and we've been saying that earnings perhaps have peaked out, but the kind of cash flows that we are seeing with respect to the SIP money coming in, with the kind of money that mutual funds are sitting on, well over 1 lakh crore rupees, what is to say that this momentum can't continue on the upside for the next few months as well?
Sure, Nisha, I think so. Absolutely, we will not be able to ever probably time the peak. The momentum might, the liquidity flows will probably add on to the momentum. The markets could continue, but as a fundamental analyst or an investor or a mutual fund manager out here, I think what is important is to track earnings and leave the PE expansion part or the liquidity part to the markets. From when we look at it fundamentally, if earnings isn't picking up, and only flows are driving the markets, it reminds me of 2018 first half, where finally the market gave up because earnings wasn't catching up. So we would track earnings of companies, sectors where we think there is comfort, and keep investing into them. And there are pockets in the market which are completely driven by liquidity and and fundamentals are not justified out there. You would be pretty cautious on those sectors.
Let me flip that question on its head then, Aniruddha. How difficult it is to find ideas right now, because you're getting those inflows, you have to deploy it one way or the other. How are you looking at finding those opportunities? Are you looking for safe havens within the large caps, or you think you're better placed within the mid cap and the small caps which are unexplored right now, or do you just stick with the momentum?
So Anisha, actually when we look across the market, there is absolutely no doubt large caps give you the maximum amount of comfort today, especially segments like financials, private sector banks to that extent, have not participated to that extent. And if at all, if someone is looking for a downside protection, that could be something. Consumer staples and even consumer discretionary. I think in the last 15 years, this is the first time I'm observing that the consumer story, which is more structural in nature in a country like India, is actually trading at valuations below the cyclical industrials. This has very rarely happened. And hence, if someone is looking to build a long-term portfolio, maybe consumers could be a segment where one could probably go ahead and invest, at least from a valuation, relative valuation perspective. It offers a lot more safety. Within market capitalization, I think large caps, followed by pockets of small caps, and finally the mid caps. I think the mid caps is where a lot of money flows in. There are only about 150 names as per the regulator, which is termed as mid cap, and hence that segment, in spite of earnings being weak, is just holding on, which makes the valuations even more expensive.
Enough. I think those definitions also need to be reworked. But you talked about consumption as a big theme. But if I have it right, and correct me if I'm wrong here, in terms of your sector allocation, consumer staples and discretionary are at the bottom of the rack, while your highest allocation seems to be in industrials and financials, and even IT for that matter. Are you looking at flipping it on its head now and maybe going a bit overweight on consumption and trim your positions in industrials and financials?
So Anisha, when we look at it, we actually combine consumer staples and discretionary together as a segment. So we talk about consumption generally, and there we got a reasonable exposure. On the industrials part of it, luckily we are into a couple of names where we think valuations are still reasonable, and hence there is no reason for us to flip it around. But if the markets continue rallying without earnings, what we need to ensure is that the earnings in the portfolio, at least portfolio company continues to remain stable. And from that perspective, we've got defensives like healthcare, consumers, we've got a reasonable exposure to IT, plus financials, probably a segment which hasn't really participated in the markets. On the industrial side, as long as relatively vis-a-vis the overall peer set, we've got companies which have better earnings and probably available at a little more discount to vis-a-vis where the the sector is trading at. We are comfortable. So, frankly speaking, we are not looking to make any major changes into the sector.
Okay, fair enough. But a quick question before I let you go, Aniruddha. What within financials looks attractive? Because it's become very segmented now, right from private large banks to the mid-tier banks to the public sector entities, NBFCs, insurance and the whole lot, even microfinanciers and HFCs for that instance and gold financiers. What within that is your pecking order?
Sure. I think you are absolutely right. It's very diverse. But within that, probably the private sector, large banks offer this highest safety net today. But having said that, mind you, it will offer you downside protection. One needs to see what kind of growth comes across. So from pure downside protection, probably financials on the lending, large lending private sector banks would be a good call. We also look at it and dissect it on the lending side. We want to see players where the collateralized lending is at the maximum level, the highest level. So from that perspective, when you look at it, I think gold financing companies have a lot of safety net in case an asset quality cycle plays out on the negative side, because they are more than 100% collateralized. And so to that extent, gold financing companies and large private sector banks would where probably we would find some amount of safety within that sector.
And given the chinks in the armor that we have seen in the asset quality of late, it will be a prudent bet to perhaps look for those names as well. Thanks, Aniruddha, for making time and speaking with us today. So that's a view coming in from PGIM. But
if you like this video, then like, share and subscribe to ET Now.